So this is the most important stock market data that nobody talks about, and it's the reason why most people stay broke. Everyone thinks that the stock market is risky, but the data says the opposite. Over the long run, over 50, 60, 70 years, the S&P 500, the stock market, has returned about an average rate of about 10% per year. But over the last 10 years, the stock market has averaged 13%. Meanwhile, the average investor has averaged 9%. And over the last 20 years, the stock market has averaged 9.9%, and the average investor has averaged 5.5%. And that gap may sound small on paper, but that could potentially be hundreds of thousands of dollars in lost money. So where did all that money go? People literally sabotage their portfolio. The average investor spends about 6 minutes before buying a stock trying to analyze the charts and trying to figure out which one they're going to buy. And then they buy when the prices are at extreme highs when everybody's buying, and then when it crashes, they sell because they're trying to time the market by trying to pick the best stock. But the craziest part is if you didn't do any of that and you just bought the S&P 500 and held it, you would have done better than 90% of individual investors. And it's not because you're smart, but it's because you're disciplined and knowing that it's not about timing the market, it's about time in the market.